about you, but I know that I love saving money on taxes wherever possible. And since you have to have health insurance anyways, why not be investing in something that is covering your health and also increasing your portfolio? Quick disclaimer, even though I do actually write technical articles for financial advisors, I am not licensed myself. So please do your own research and don't take anything I say as financial advice. In this video, we're going to be talking about what is an HSA and how it's a triple tax benefit. So I'm going to explain that in just a second. But for everybody who's new here, my name is Anna, and this is my YouTube channel, Finance Sister, where we talk about everything related to money, having a balanced lifestyle, and reaching financial freedom. This is a video, a part of a little mini investing series on basic investing principles that I'm going through. So if you haven't already, go ahead and check out that playlist. Go back and watch a couple and stay tuned for the ones that I'm coming up with next, and hit subscribe just so that you get notified on when those videos are posted. So let's clarify exactly what an HSA is. It's a health savings account. So basically the way these work is that you contribute money into these HSA accounts, and you're able to use these contributions towards qualified medical expenses up to the age of 65. But after 65, it basically works like an IRA, where all of that money that if you haven't used it on anything medical through previous years and you've been contributing to it, you can actually withdraw that money tax-free, and you can use it for anything and there's no penalty with it. In order to have an HSA, though, you have to have an HDHP, a high deductible health plan. So depending on what your employer offers, or if you're on your own looking for health insurance, do the math and see if it makes sense for you to have a high deductible health plan, because this can range anywhere from like $2,500 up to 10 grand for these high deductible health plans. For us specifically, my husband has a plan through his work where we pay a much lower premium per month for a high deductible health plan, but they actually contribute half of our deductible into our HSA. So we can use that HSA to basically meet half of what we would need to pay if we had a big procedure or we are expecting a lot of medical expenses. For example, I'm 39 weeks pregnant right now, so we are expecting that we're probably going to meet our deductible of $5,000, but his employer already put in $2,400 that goes towards that. So we've been able to contribute more to our HSAs so that we have that amount, plus we have money in our HSA to put towards other qualified medical expenses that wouldn't necessarily be covered under a normal health plan, like prenatal vitamins, other supplements, even like baby monitors, etc. Some of those things are actually qualified HSA or FSA expenses that you can use your HSA contributions towards. If you couldn't tell, I'm a really big fan of HSAs because they make sense for people who are either really healthy and don't go to the hospital a lot, or people who have significant health issues and know that you're going to be paying a lot in medical expenses every year anyways. So your deductible plus lower premiums might actually make more sense than having a more traditional plan without the HSA option. All right, so let's go back to what I said about the triple tax benefit, because that's also another indicator where you could be saving money on taxes, so that also should be factored into how much you could be saving on your health insurance by choosing this plan. So triple tax benefit, what I mean by that is all contributions are tax deductible, that's first and foremost, but all contributions are made using pre-tax dollars. So basically this is like if you were contributing to a traditional 401k, which if you haven't already watched the video on where to invest first, go check that out, because I basically explain traditional versus Roth. But traditional accounts, you're contributing using your pre-tax dollars. So that means you get the tax deduction immediately, but you have to pay money on all of the capital gains and contributions later when you actually withdraw in retirement. So, but for the HSA, that money grows tax free. So that's the third way that it's a triple tax benefit. Even though you're contributing using pre-tax dollars, so that money has not been taxed on. It grows tax free, and you can withdraw it without paying any kind of taxes on it after the age of 65 for any non-qualified medical expenses. But any qualified medical expenses up to that point, you can just use your HSA debit card, and it's essentially like your dollar is being increased by whatever your tax rate is. So like 20-30% is what your dollar is worth more. So instead of $1 at like after tax dollars, it's actually worth like $1.20 or $1.30 for in terms of buying power. So if this option is offered at your company, or if you're self-employed and you want to go through a broker and get quotes on what actually makes sense financially, definitely check that out, because it could be a great option for you to take advantage of and be paying for health insurance, but also have the option of contributing pre-tax dollars, getting the tax deduction, and basically treating it like another retirement option. So if you've enjoyed this video, please like it. It helps my channel a lot, and thanks for watching.